Okay, I'm going to go ahead and get us started here. Thank you again to everyone for joining us. We are going to discuss transferable tax credits, how to manage risk and manage and mitigate risk, and how to maximize opportunity in the context of a transferable tax credit transaction. I'll be hosting the webinar. I'm Katie Bates with the Crux team, introducing the rest of the folks on our call today. We have Joyce joining us from Vinson and Elkins. Mike's practice focuses on energy infrastructure and finance. Mike has represented clients in numerous cutting-edge transactions in the energy and infrastructure field, with a particular emphasis on renewable energy sectors like solar, wind, and storage. It's considerable experience in geothermal, biomass, coal, and gas-fired and nuclear projects, and as well as with joint ventures, the disposition, acquisition of energy infrastructure assets. So Mike, thanks for being here. We've also got Nicholaus joining us from Ryan. Nick is responsible for leading a team focused on renewable energy investment initiatives. Nick has served some of the largest companies in the Fortune 1000 and has extensive experience helping his clients optimize their solar investment strategies through tax efficient planning. Jerry Smith is joining us from Atlantic, where he's the managing director, head of tax insurance, and is located in Atlantic's New York office. Prior to joining Atlantic, Jerry was most recently a managing director at Credit Suisse for over 14 years, where he led Credit Suisse's global strategic transactions group and was the head of tax for the Americas. And then last but not least, we have Rob Parker, Crux's chief commercial officer. Rob joins us. He's responsible for all aspects of Crux business development. He was most recently the chief financial officer for Rev Renewables, which is an LS Power portfolio company. Rob has done stints with Google, AES, and LS Power prior to joining the team here at Crux. So again, thank you everyone for joining. As a quick intro, we are going to work through a couple of primary aspects of risk. We'll present some questions to our speakers and ask their perspectives on managing risk in the context of a transaction. We're then going to open the floor to questions from our audience. We've already received some great questions through our registration portal, but we welcome any additional questions through the Q&A feature on the Zoom. So as you ask those questions, we'll compile and we'll address as many as we possibly can. We will keep the webinar to 45 minutes, be respectful of everyone's time. And so with that, I think we're going to go ahead and get started here. So when we started thinking about this webinar, we wanted to address the different aspects of risk in a transaction by kind of creating three particular and perhaps non-exhaustive categories of risk. So when we think about what those categories of risk are, we sort of divide them into project risk, recapture risk, and then eligible basis and disallowance. So let's kind of begin this conversation talking about project risk. Michael, as an attorney representing clients on both sides of a transaction, how do you protect prospective buyers from the kind of risks that are characteristic of project development, things like the risk of delay, regulatory hurdles? How do you see those risks manifesting in the context of either tax equity or transferable tax credit deal?
Thanks, Katie. I think to answer the question, I'd first start with where we were prior to transferability, and that is the tax equity market, which was a project finance-based equity market where people who wanted to monetize credit need to be in the equity stack and really appreciate the project risks, everything from the construction risks and their forward commitments relative to lenders, being able to enforce those obligations, to making sure that the project was going to be healthy and generate the credits they had paid for in advance at the front end of the transaction. Over time, particularly in things like wind, we developed things like the PAYGO structure that mitigated that risk in terms of how the credits were paid for. But point is that as an equity provider, you were fundamentally standing in front of project risk, albeit with generally a strong sponsor there to support your economics. What's fundamentally changed with the IRA and the ability to monetize tax credits through transfer is reducing the friction of kind of getting your arms around the project, so to speak, because you're fundamentally now just investing in or purchasing the credit as opposed to investing in the project. And therefore, you don't necessarily need to be as concerned with project risk, depending on how your transaction is structured. And I'll talk about the two kind of fundamental credits that we see in the market, the PTC and the ITC, and how they're different. With the PTC, generally the deals that are going off in the early stage of this market have been strip deals, whether it's a 1 year as generated strip or a three-year strip, or even the full 10-year cycle of the production tax credit. How the deals are being structured to date is on an as generated. So once the credit is generated on the PTC, you get the output from the seller that you can hold that up to the light, confirm that the credit would be produced based on the PTCs available, and go ahead and book that on your return often on an estimated basis. So point being, you're not paying for the credit until you have some objective proof that it's been generated. So really reducing the project risk. I will say that that is not necessarily always optimal for developers because it's harder to leverage that income stream given the subjectivity or the risk to the sponsor and therefore to the lender standing behind them, that those credits are generated in the volume that are anticipated and expected when they model out their debt. So the market's catching up to that. There's a deep bench of sophisticated lenders that serve this space that appreciate the distinction between the forward commitment where you're paying for 75% of the expected credits and using that PAYGO scalar to level out the balance on an as produced basis, and a forward commitment to pay as generated on a 100% basis. And we see things such as deeper discounting, sponsor credit support, ways that lenders are working to get comfortable with those 10-year forward commitments, but that market is developing. On the ITC bit point where you have the 30% credit or whatever your credit might be based on adders and prevailing wage compliance generated when the asset is produced, you care about the recapture risk, which is another subject that we're going to talk about here, so I won't steal too much of the thunder. But note that we're looking to both understand that there's healthy economics to the project, a good spread between operating costs and the revenue anticipated, but really not doing the deep dive diligence, again, that traditional tax equity project finance required, because ultimately one of two things are generally supporting ITC deals: a strong sponsor credit, standing and indemnifying full stop for a recapture issue, and I do mean ITC insurance policy, particularly when there's debt on the asset, where the insurance will step in to cover the casualty and foreclosure risks. So again, reducing the friction of the transaction across the board. Anecdotally, I'll note that when we were thinking about this, is that after the passage of the IRA, we kind of took our tax equity papers and held up a membership interest purchase agreement and looked at all the conditions pressed and all the deliverables and had a healthy debate about what's relevant to a credit transfer purchaser as opposed to an equity investor. And while you can see some logic for looking for environmental reports and regulatory status, that kind of brings you back to where you were and takes away the efficiency and recreates some of those barriers to entry that these provisions were trying to avoid. What we ultimately got comfortable with is these things are more like RECs. They're more like a credit that you can book and transfer, and therefore you don't necessarily need to be as concerned with those risks because you can structure your payment mechanisms to solve for them. That's at least if you're the buyer. Again, kind of gaps for developers or sellers in that and how that might work. But it's an important feature in terms of just the mitigation of risk from the buyer perspective, and then how the developers are working to kind of fill that gap.
Thank you. And I want to definitely give everyone else an opportunity to comment as well. A lot to think about there, but thank you for that very thorough description.
Yeah, and I think one thing to add there, something that we might not necessarily think about, on the developer side as far as project risk, or actually we do think about it all the time, but from the buyer side, one critical point is project slippage and project delays. As Michael referenced, it's in some ways less critical, in the world of transferability than in tax equity. But for buyers, especially major corporates, when they're looking at buying these credits, they're looking at buying those or contracting on those early in the year with some level of certainty as to whether those projects will place in service. And obviously guidance came out, allows, corporate taxpayers the ability to use credits that they expect to receive to reduce their estimated payments in earlier periods, which is really a big benefit to corporate taxpayers. But they need to be critically clear that they're going to receive those credits. And that is, to be clear, that is a real ITC item for the most part, I would say, because it's based off of placed in service. But that is a critical point as buyers are looking to structure these deals to either provide certainty that these projects are going to place in service, or they're looking for specific provisions to effectively mitigate that risk. So maybe there's some teeth in it to say, if the credit is a 2023 credit, we'll pay 92 cents on the dollar, but if it's a 2024 credit, we're only going to pay 90. Or, some buyers are basically saying, we'll take the credit if it's 2023, but we won't take it if it's 2024. So I think that market is certainly developing, or that component is developing, but from the buyer's perspective, that is certainly a critical point as we think about, project delays within, if it's within the calendar year, not as big of an issue. Falling out of the calendar year or falling out of the tax year of the seller, it creates, some additional complexities for buyers.
Yeah, I think that's right, and that's Nick and Michael, exactly what we've been seeing for deals kind of on our platform, right? First, diligence is much more confirmatory in nature. A lot of it is being handled by diligence and insurance, but really it is the COD risk that is the challenge, and to some extent, some people just say, hey, I only want to look at things that are in service, right? And there's a price factor to that, or they'll say, hey, I'm really wary of projects that have a December COD that aren't already 99% there. And so, again, there are options available. And again, like it often does, a lot of this also just falls to price. But definitely kind of the slippage issue is one of the biggest issues. Also on the diligence side, where we are seeing, I think, a little more diligence is that the other technologies, right? Solar and wind have had tax equity in various forms for some time now. But obviously there's 10 other credits that are transferable and that are out there. And those are beginning to come to market. And so I think those are areas where there's diligence, not just on the product itself, but also like the technology and what it means and what other unique risks may exist.
Yeah, and I think to that point, Robin, something that we discussed prior to this call, and I think it's an interesting point to try to surface here, as much as there might be, it seems like there might be some curiosity around, unique factors for different kinds of projects and different kinds of technologies. To what extent do you think a credit's still just a credit? Does a buyer really need to be an expert in bioenergy or different kinds of storage or manufacturing in order to feel comfortable with these different credits?
Well, it's funny, guys, on our pre-call, I mentioned a credit is a credit. I mean that solely in the purpose of booking it on your return and the value on the return, as opposed to the question you're asking, which relates to risk. And, frankly, what we've seen is buyers approach that question differently as between different transactions based on their available capacity and what they're solving for. Put another way, you can take some ITC deals that might slip into 2024 if you're solving for 2023, but you can't fully commit to that. You can't have all your transactions work that way. So we've seen folks go with safe bets as generated PTCs often, and then looking at an ITC or a forward PTC deal to cover on, knowing that they can access the market later in the year, maybe at a heftier price. To Rob's point, it all kind of comes back to price to fill a gap should it develop. Not a perfect solution, but noting even an individual buyer looks at the various transactions they might participate in differently depending on what they've already booked and covered to date and what the risk of slippage is.
Right. Yeah. And I think, go ahead.
I was gonna say, I would just echo that, Michael. I think that is a really strong strategy that we're seeing from a lot of our buyers is looking to set a baseline with production tax credits, given the predictability, and then call it top up with ITCs as needed. Obviously their forecast change as well, so that plays a factor. I think we have seen a little bit of back and forth as to whether buyers care about technologies. I think it comes down to project revenues and the story that is really told around that for buyers. Battery storage as an example, it was, in the tax equity space, battery storage was struggling to get traditional tax equity if it was going to be fully merchant. Whereas, in the transfer market, it's less of an issue, especially the way in which revenues are generated for projects like that. So I think there's a little bit more, people are a little bit more agnostic to technologies in the transfer market, given just kind of the behavior of those credits.
That's great. Thank you. I wanted to go ahead and we can kind of jump into recapture risk. I'll acknowledge we've gotten a couple of good questions, both kind of related to the tenor of filing and timing with credit. So I want to come back to those once we've addressed some of the other facets of risk. But now kind of turning to the topic of recapture risk. Jerry, can you kind of talk to us from an insurance perspective sort of the realities of recapture risk in the context of a transferable tax credit transaction, kind of how does that work, who owns it, and maybe as part of that also share some of the other risks that are commonly covered by insurance, either for ITC or PTC transactions.
Sure, Katie. And apologies in advance if I'm in an airport, so if a loudspeaker comes on, I'll put myself on mute. But just to address a couple of the points as well that were well made earlier, I think the presence of tax insurance helps make a credit be a credit at some point. Doesn't deal with the timing issues, but at least deals with the risk. But what we're seeing is that a lot of the new entrants are really not as interested in doing the deep dive on the diligence side of things. They're looking for a simple solution. They owe $100 of credits. Or a tax. They'd like to buy $100 of credits for less than 100, and they don't want anybody coming back to them down the road. And that segues now into your recapture point. As was well, the point was well made earlier that recapture is a risk, and it's bizarrely one of those ones that the government put on the buyer, the transferee of the credit, as opposed to keeping it in the place where folks are a little bit more aware and in control of the activities. So some of the risks, potential risks, are taken off the table. There's no longer a risk to the transferee for sales of interest in a project company that are done by the sponsor. So that's helpful. But they're still left with any sales of assets, any foreclosure and the consequences thereof, and any sort of environmental issue that destroys the facility. So helpfully, insurance is there for each of those points, obviously with a bit of diligence on the insurance side of things, but it is there. So it's useful to know that that exists. Some of the other risks that are covered, ITC has more of them, but they share it with PTC on qualification. You know, is the credit due or available? Prevailing wage and apprenticeship. Have the procedures been followed? And is that, as a result, avoid a penalty of 80%? And the various adders that are available: domestic credit, energy community, and low and middle income communities credits as well. So insurance does exist for each of those. Separately, it continues to exist for ITCs on qualified basis. Is the fair market value appropriately developed and therefore available to apply the credit to? And then transferability, and also, structure and allocation. Same thing, just does the credit get to the place it's supposed to go? So in a transferee deal, does the buyer actually rightfully receive the credits? And then finally, it's the recapture point we just mentioned. We could talk for a long time on this stuff, but let me stop there because I know we'd like to get to some questions.
I'll maybe jump in there and just say that one of the key components of transferability in conjunction with the availability of insurance, as Jerry was just covering, is it has done what the legislation was intended to do, is open the market, not just to new buyers, which we spent a fair amount of time focused on, but to developers that were maybe formerly greenfield developers that would sell their projects at around NTP because they didn't have the balance sheets to support indemnities that the tax equity community would expect. And with the access to the insurance, albeit at a cost, think of it as somewhere between 2 and 3 cents on a dollar credit, depending on the coverage you're looking for. That has enabled developers to start building and holding assets long term, building up balance sheet, and kind of stepping up to that next level. And that is, again, to what the guidance, what the legislation was intended to do. And we're seeing that in the early stages actively now.
One of the interesting things that we're seeing with respect to insurance in risk and maybe a gap in the marketplace is smaller deals. Insurance economically, when you get kind of below 5 million or so, can get relatively expensive. And there's a lot of projects in the market that are, below that and some well below that. What we are starting to see that's interesting is, some investment type firms or other firms that are big need, have large credit needs, and are actually a little more risk taking and looking at self-insurance options where they're taking a portfolio approach and effectively kind of underwriting it themselves, obviously taking a discount and kind of internalizing that discount as their own insurance, or looking to put like a master umbrella policy in place. So, I think there were a bunch of questions, and it comes up a lot in our discussions about smaller credits. That is, I think, a challenging area versus what the large portfolios or utility scale developers are able to do. But there are solutions that are kind of beginning to evolve to address that.
I wanted to actually incorporate one of the questions we got through the pre-registration process, Jerry, that I think is really germane to this discussion. And it's basically, what are the key types of credits, including bonuses, that need to be better de-risked, and what needs to change to de-risk them? And I can certainly kind of anecdotally say, and Rob, you may agree or disagree, but it seems like we have a very wide representation of technologies and credits that folks are seeking to claim. But I would be very interested in hearing, Jerry, if you, from an insurance perspective, see particular credits as requiring some kind of maybe guidance or something else to help make them insurable or improve their competitive positioning.
Yeah, sorry, I was on mute there, Katie. But yeah, it would definitely most there's a clean path to most of the credits and the adders. The one that's been most difficult has been domestic content, and that's because the rules are very, very particular in what you need to prove that you qualify, and it requires going to your suppliers and getting specific cost data on what they produce, and also where they themselves produce or procure some of the subcomponents. And they're very loath to deliver that because they want to protect their profit margin or their proprietary processes, et cetera. So there's a couple ways to deal with it. One is that you just wait for the new regs to come out, and hopefully that gets clarified and made easier. Or separately, we've been working with some accounting firms to try to create a lockbox of sort where they can get the data from the suppliers under an NDA that can be then shared with certain people, but only the people that need it. Tax return preparers, tax attorneys giving opinions, the insurance underwriter, and then ultimately the IRS if ever it's challenged. So that's been the toughest one. The other ones all have a path that we've seen and have been using.
And then from the PTC perspective, we don't really hear a lot about insurance for PTC deals. We do know that there is typically at least some kind of insurance there. Is there anything, Jerry, that you see and offer related to PTCs that's worth kind of mentioning here before we move on?
Well, it's interesting you say that you don't see it in PTC deals, because the very first deal of transferability that was done that we know of anyway was one we supported. It was the Invenergy deal that was announced earlier this year, and that was a PTC deal. Now, the interesting thing about that, and it's also a trend, I'd be interested in what the other folks are seeing, but we're seeing a lot of tax equity players continuing to be involved in PTC deals, but then to reserve optionality to be able to themselves transfer the credits down the road or to assign them, because you can only transfer once. And in that deal and others like it, we're seeing insurance demanded of the tax equity investor that covers both their own exposure and that of any future transferees. So that's a category where you do see it in PTCs. I think what you're really referring to is any PTCs that are coming due this year and are closer in time. For those it's a question about qualification, again, for what credit you're claiming. Are there any adders that are available? Same sort of thing as with the ITC, and then ultimately the transferability.
Yeah, maybe piggybacking off that, I'd say on the gun construction and prevailing wage exceptions, we've certainly seen policies placed there, still highly relevant to PTCs. But echoing something that Jerry stated, that's not necessarily an insurance question or an available insurance question, is the fact that the tax equity players are largely building in the transferability sections into their deals in real time, enabling them to free up capacity. Keep in mind that a lot of those banks have been doing those deals. It's oversimplifying it to suggest it's related. It's largely tied to other business, serving their bank customers, and wanting to make sure that they're able to continue doing that by offering effectively a one-stop shop to monetizing credits and monetizing depreciation as well, which can be powerful, but leaving a back door open to move credits out from under their own banner and to transfer them to someone else. What's currently shaping up is at what price and how that's fixed between those parties, whether it's a pass-through, upside, downside sharing, floor prices, et cetera.
Yeah, and the last thing I would add is I think we're seeing a little bit of a difference from the buyer's perspective as to looking at brand new PTC projects versus repowers. So we've seen a number of insurance policies come out on repower projects because of the fact that when you're doing a repower, you're generally tied to the 80-20 rule, which requires a fair market value assessment, just creates some additional gray area. So for those repowers, we've seen a number of insurance policies come out because it's a little bit less straightforward.
Nick, I'd like to kind of stick with you, and we want to just now shift gears a little bit, talk about eligible basis, disallowance, these kinds of things. And we actually got a really good question that I think is better than the one that I had scripted. So I'm just going to go ahead and answer this question. Can you kind of, it's a nice general question, so I would like it. So can you kind of speak to the viability of a step up in the ITC market and how those are how you sort of finesse that with a transferability deal?
Yeah, so I think the market is continuing to develop, right? I think that for many buyers, 2023 has been good because it's kind of the 101, where for transferability, you've seen most projects or a lot of projects coming to market with just at cost basis, right? So that when you're thinking about relevant risk in basis, that is about as straightforward as it gets. If you spend $100 on solar panels, the chances that the IRS is going to come back and fight you about that is relatively low. When you add in the fact that most of the projects that came on this year are safe harbored for prevailing wage and apprenticeship purposes, that adds kind of an additional point as well, where the basis and the credit qualification, at least at 30%, should be relatively straightforward. On a go-forward basis, I think that the market is moving more towards, call it hybrid approaches to this, kind of as Michael mentioned, right, where you see a lot of the major banks are continuing to do tax equity in its traditional form, but adding this level of transferability to their contracts so that they can deleverage their balance sheet and basically monetize those credits through transferability. So if you are going to be buying credits out of a tax equity transaction, well, now you're reintroducing the concept of a fair market value. So for those who don't know, kind of the 101 of this is by virtue of selling the project that you developed into a tax equity transaction or a like-kind structure, you trigger a step up to fair market value, which generally could be based off of an income approach. So if you spent $100 on that credit, your step up, your fair market value might be $120. And that is what the credit would now be calculated based off of in the partnership. That is always the area where it has always been a sticking point with the IRS. That's always the part that they've looked at when it comes under audit, is that fair market value and the assumptions that go into that. So interplaying with the insurance component, I would say to this point in the year, a lot of buyers just say, just wrap the whole thing. We want the full coverage. But even larger developers who have the balance sheet, in many cases, they will cover off items where they find relevant risk. One of those areas will be the fair market value step up. So I might see that being kind of where the market goes, where even if we're going to have, even in instances where buyers get comfortable that there's not going to be insurance, that the fair market value step up might be the portion that they ultimately cover off. And last point is, I think it will come in a variety of shapes and sizes, that fair market value step up. I think the bank example is the most traditional example, but there's a lot going on in the industry. Once the lawyers put their mind to it, give the lawyers 8 months to put their mind to something, they'll figure out the way in which to achieve that step up. So we're seeing some call it hybrid, some other types of transactions whereby private equity is coming in and investing a certain amount in order to effectively achieve that step up as kind of a third party purchaser. So it's gray at the moment, but I expect that as we move through the years, you're going to see a lot more projects coming to market with fair market value step ups than we are in 2023 in the transfer market. And that is it's a critical point from our perspective for buyers. It's a point that they are very focused on in review, really making sure that step up in the appraisal that goes into it, the underlying assumptions of that are correct, that the operation and maintenance and expenses are supported by real contracts, that there's not a lot of kind of peanut butter high level assumptions in that underlying appraisal. So that's from my perspective as a tax advisor, that's really where we spend a lot of our time in ensuring that we're comfortable with the appraisal and that we feel that the fair market value assessment is ultimately reasonable.
Yeah, I would echo that. Nick's absolutely right. We're spending a lot of time doing structuring to allow folks to avail themselves to stepped up fair market value to leave on the table. Generally, 15 is seen as safe if you structure it properly. In other assets such as storage, R&D, we're seeing things in excess of that substantially in some cases, often backstopped by insurance, just given the risk profile. But I absolutely agree that next year you're likely to see a lot more in the marketplace that has a stepped up FMV. And to keep in mind, if you're the seller, that there's a cost to that. There's not just a cost in terms of what your direct lender or private equity type lender charges you to do the prep deal and how they might structure it, but also you're probably already in the insurance world anyway because it's an ITC. You're almost certainly in the land of insurance when you're talking about FMV step-ups.
Well, and I would like to kind of incorporate a question we've gotten about how much tax insurance coverage you're seeing now that we're kind of talking about that. And Jerry, I muted you because we got a little background noise, so just a heads up, please feel free to unmute. But how much insurance coverage are we seeing required in the transactions? And I assume required here is required by the buyers. So really, do you see a buffer above the credit amount for interest, penalties, gross up costs, et cetera, et cetera?
Yeah, maybe I'll just take the lead and Jerry can tell me where I'm wrong. So yeah, so I would say it's been interesting from the buyer's perspective. You know, I think early on, especially, they were asking for full scale wrappers. And what does a full scale wrapper look like? Is it 100% of the credit value, or is it somewhere north of that? I think that really it's a commercial point that varies by buyer. But there's a couple instances that affect that, right? So in the instance where you have a project where there's no parent level guarantee, or there's no guarantee coming from the developer or the owner of the project, generally we're seeing buyers looking for something north of 100%, call it 120%. I think the maximum doomsday scenario is like 150%, right? If you factored in interest, penalties, a gross up, excessive credit, and so on. And so that's that is one end of the spectrum. But that is also a cost that, is borne by, there is an inherent value to that for some sellers, and that they are not having to put up a seller guarantee in that instance. The middle ground is if there's a seller guarantee that's not the most credit worthy, you could potentially get away with something less than that, or some level of insurance. And then the lowest end of that is really what we kind of just talked about, which is covering off very specific risks, whether that be a fair market value step up, or just an ITC adder, or really just focused on basis versus recapture. So we're seeing, I think from my perspective, we're seeing policies of all shapes and sizes, kind of fitting the relevant needs of the projects. I have been preaching to buyers, I think new buyers want to say, let's just cover everything. But there's inherent loss of value there. Jerry will do very well with that if we just cover off everything for every single project, even if there's not kind of inherent risk in it. So it's certainly evolving, and I think it will continue to evolve as buyers get more educated on the actual risks of a given project.
Nick, by the way, I just want to chime in. There's no problem with Jerry doing well, by the way. Let's just have that out there. No, but I agree with almost all of what you said there. One thing I did want to make a point of, though, is that yes, there's a cost of tax insurance, and this will kind of flip over to Rob, but I assume that you're seeing the price for transfers on deals that are insured are at least three percentage points higher than those that are uninsured. That's kind of what we've been seeing. So if that's true, then it pays for itself.
Good point, Jerry.
That's right. It often does, because you're right. In the scenarios where we're seeing folks kind of, so to speak, self-insure, there's probably a price decrease that is larger than what insurance would cost. And that's also just to reflect, like, there's an administrative headache and savings that the developers are paying for, and it's not wanting to deal with having to procure insurance, for example. They're willing to compensate for. So yeah, on an economic basis, I absolutely agree with that, Jerry.
And frankly, for some people, for many buyers, it's just a non-starter. They've gone through their process. They have approval to buy credits that have insurance on them. And it's not just the price. You could be limiting the pool of potential buyers you're looking at by not carrying an insurance policy.
I will add that we are starting to see, for a very select handful of sellers, deals that are relying on investment grade guarantees. And that is typically between a deal between two very large investment grade companies that know each other.
Rob, do you want to, let's maybe take some of these questions about pricing, and we can kind of send that over to you. We've got, a question in here about the economics around not only, I'm sure, of course, the ITC versus PTC, but also the timing, the delivery of the credit, so forward selling those credits, and then, of course, presumptively, working in some kind of a discount, or maybe not. So I think, if you want to kind of walk us through commercially sort of what you're seeing around pricing expectations and on both sides.
Yeah, I mean, I guess the biggest caveat of this is a new market, right? We're experiencing our market's fourth quarter, our first kind of rollover to the next fiscal year. And in the early days of the market, with a few exceptions, but generally as it comes to ITC deals, the market is very much blinded and blinders to like this year, right? Guidance came out in August. Buyers have gotten religion because their advisors, their lawyers are telling them this is real, this is not too good to be true, we need to be doing this. And there's sort of this rush to 23. And pricing right now is actually very strong. And others feel free to jump in if anyone has a different perspective here. People are now looking at 24 deals. And companies that are pretty confident in what their needs are and want to start focusing on first quarter estimates are looking to do deals. There is a price discount at the moment. It's not huge, but it's there. I think that will go away very shortly. Then there's this question of like, what is steady state pricing anyway, right? Because the market right now is generally short credits. So pricing is strong. So there's this overlap of, okay, we roll to next year. What is the actual dynamic of 24 when there's more supply and more buyers? What does that look like? What is the dynamic for second quarter versus third, fourth quarter when buyers have a better sense of their tax liability for the most part? And so there's a lot of moving pieces that makes it hard to kind of isolate all the differences. So, I guess my short answer is, and then I'll turn it to Nick, is there is a price discount for 24 right now. It's probably a couple cents. There is a big discount, I think, for 25, if there are any 25 deals even being done. So if folks are used to like tax equity world, I'm planning my capital structure and putting financing in place 2 years in advance, that is generally, with a few exceptions potentially, like not where the market is today for the most part, or how it works.
Yeah, I would echo that. I think it's been a really interesting year for 2023, just because I think, the project, I think I talked a little bit about this, but the projects that are coming to market now are some projects that, were built on balance sheet that might not have even contemplated getting an ITC when they were first contemplated. So I think there's a bit of a disparity for 2023 between, buyer interest, which is huge right now just because it's the new thing, and sellers actually getting projects to market and getting them placed in service in 2023. Whereas a lot of sellers have very large portfolios going forward, 24, 25, 26. So it'll be really interesting to see how the market balances out there. The other thing I add is, I think some of the conversations earlier in the year were like, we think we could get to 97 cents on the dollar within the next couple of years. From my perspective, that's just not, I can't see the market ever getting there. The real reason is just because corporates have hurdle rates, and as good of a deal as it might be, as low risk as it might be, there's a point at which corporates just don't care and they're not going to do the deal. And so, state tax credits that have been around forever, those can trade at a 7% discount. So I do think that there's 23 could be a good barometer for going forward, but I think we're entering a little bit of an unknown here. Not just the credits that we currently have, but also new types of credits that are coming to market in the coming years, to see how that kind of supply demand dynamic plays out as we move forward here.
Well, and with that, Rob, I'm going to send it back to you again with a question that's kind of a bit more of an expansive interpretation of risk. And obviously, Nick, when you're talking about the corporates have a hurdle rate, like this in some ways is a qualitative measure too. Like, do I decide to participate in this? Do we decide to take the time to try to figure this out? And of course, as anyone does that, they're going to think about what are the risks associated with this market. And while we've been talking about some of those risks, especially insurable risks, there are other kinds of risks that market participants have to weigh, like documentation, compliance, maintaining confidentiality. And so, Rob, those have obviously been big issues for the team at Crux to try to think about Can you talk a little bit about where those issues kind of come into play with our software and with our process?
Yeah, absolutely happy to. It's a new market, right? And I think buyers and sellers are both trying to, figure out, how this market should work. And what we're doing at Crux is trying to provide the tools for everyone. And a lot of those tools are addressing some of these other risks that we think are best managed through software. So some of the ones you mentioned, like documentation. And so ensuring that we have full data room functionality, but also that it's auditable, right? I think buyers and sellers both want to avoid scenarios where there's a potential 20% penalty, right? If there's a challenge and diligence wasn't done, and ensuring all that resides in one place. That kind of ties into IRS compliance. Another important aspect for sides that isn't necessarily kind of risk per se, but a different type of risk is confidentiality. What is the point at which buyers and sellers want to disclose each other? And so how we've designed our platform, for example, is that buyers and sellers are both anonymous with sort of teaser level information until there's a commercial alignment on price, and discovery kind of happens that way. And so as we sort of step back and kind of, I guess, maybe advice for buyers, that are looking at this is sort of first, think about the criteria that matter to you. A number of firms develop policies on what they're looking for, right? Kind of build a team of advisors, legal, insurance, accounting. And then really most critically, that is one of the core functions of Crux is to look at the whole market, right? Is to be able to see every credit that's out there and apply your criteria that you've developed and down select. But also embedded in that is it provides us ability to know, like, why is this credit 92 versus 93 cents? Like, what is a pricing difference here? Is this credit priced to where we think it should be? And be able to kind of have that information at their fingertips, because most buyers don't want to become power experts, but being able to justify why a credit's priced where it is and having comps and having kind of a deep market provides a lot of value there from a risk perspective and an approval perspective.
I can't imagine why anyone wouldn't want to be a power expert, but I guess that's fine. Well, we have 2 minutes left, so I wanted to ask just a closing question for everyone to kind of address, and maybe we'll kind of go in the order that we did before. So Mike, Jerry, Nick, Rob, what is one piece of advice that you would really encourage buyers to take to heart as they think about the risks in this market, but also the opportunities that it presents?
I think as we've been discussing, while the transactions and monetization of credits have been greatly simplified with the IRA and the ability to transfer credits, they're not absolutely risk-free. And make sure you do your diligence, find good consultants and counsel to rely on that can help you understand what risks are and how they might be different between different available credits that are to purchase. And take your time on the front end to make sure you understand what you're buying.
And Jerry, apologies, I think you're on mute. Nick, maybe you can go ahead.
Sure, you got it. I think Michael kind of took the words out of my mouth. I think that, these projects, while there are risks, through kind of appropriate diligence and appropriate structuring, those risks can be effectively mitigated to fully de-risk these projects for buyers. So it's incredibly important to make sure that you're educated on what those risks that you're ultimately solving for, and ensure that you have the team in place to kind of do that on your behalf. Especially if you're a new entrant to the market.
Can you hear me now?
Yes.
Yes.
All right, success. I'll echo everything that everybody said there. And one of those things that I'd offer up is that one thing about us as a broker, and every broker, to be honest, is that we work in advance, and we're happy to roll our sleeves up. We don't get paid until ultimately insurance is bound, if it is. But we have a lot of years of experience. I used to be a tax equity investor at Credit Suisse the last 14 years, so I have experience with these deals. Use us. And that's what I'll leave you with.
Right. Rob, do you want to go ahead and close this
Yeah,
out?
I guess I echo what everyone else said, and just sort of add, I guess, for both sides, buyers and sellers, just list early and kind of, keep an eye on the market and kind of help develop that sense of, what credits price where and why they should, and be exposed to everybody. If you're a seller, what you want is the best net price at the end of the day. And if you're a buyer, you want, a credit that meets your criteria at the best price.
Well, that's great. Thank you to everyone. I apologize we did not get to all of the questions because there are so many good ones. If we can, we'll follow up one off. You're welcome to reach out to us at cruxclimate.com as well, and we'll get in touch with you. So thank you again so much to Nick and Michael and Rob and Jerry for joining us. And I hope everyone has a wonderful rest of your week.
Thank
Thanks.
you. Have a great one.
Thanks so much, Katie. Appreciate it.